We did it! Great job, team! Welcome, everyone. Thanks for the great work last quarter. Let's discuss the agenda items for today's meeting.
Sounds good. I'm keen to discuss the market expansion.
Hey everyone, welcome back to the channel. Today I'm excited to dive into something new. Let's get started. Well, there's been a lot of talk lately about what happens the moment Shanghai comes back online after a week plus of being dark. So in this video, we're going to separate the noise from what actually matters. And you're going to walk away feeling calmer, sharper, when way more in control. By the way, it's Tuesday, February 24th in New York. Comment what day and date you're watching from. Also, quick favor before we get rolling, if you value the work I put into breaking this stuff down. Now, here's the setup. A high-energy live stream goes live. The chat is flying. Sound check. Am I loud? Am I clear? And then a countdown. And the whole time, one question keeps coming back. Are we gapping up or gapping down? Not what's the long-term thesis, not what's the macro backdrop. Just when Shanghai opens, does it print higher or lower than where it left off? So when the host is asking gap up or gap down, what he's really doing is turning a complicated global pricing system into a single moment of theater. But if you're going to use that moment to make financial decisions, you need to know what you're actually looking at. And again, I'm not mad at the theater. I like the theater. It's why people watch live. Because the number that flashes on a screen right at the reopen can be affected by things that have nothing to do with physical shortage. For example, reopening prints can be thin. That means the first trades can be pushed around by relatively small order imbalances. If there are more eager buyers than sellers right at the bell, you get a sharp pop. If it's the opposite, you get a sharp drop. Then as more participants come in and liquidity thickens, price often settles into something more stable. That's why those first minutes can be the loudest and the least informative. Second, there's the witch market problem. People casually say Shanghai, but there's Shanghai spot venues, Shanghai futures venues. Some are more physical oriented, some are hedging oriented, some don't care about bars and coins at all. Third, there's the unit conversion trap. If one venue is quoting in yuan per kilogram and another in dollars per ounce, the conversion isn't just math. Your first thought is, aha, demand is exploding, but it could just be currency or local funding rates. Then there's the Western trading break. Liquidity changes, and you can see jumpy moves that look like gaps. And markets have rhythm. Asia wakes up, Europe overlaps, New York takes the baton. The big question, does that mean someone pushed a button or were there just not enough orders? Sometimes it's just thin liquidity. The livestream audience interprets everything as intent. Backwardation alert, near-term price higher than later price. Could signal tightness, but context matters. One print doesn't do it. Confirm across multiple venues and physical premiums before drawing conclusions. A reopen gap is not prophecy, it's a reaction. Market reconnects timelines and starts negotiating. Holiday reopenings compress information. News, positioning, and currency moves all hit at once. Feed delay matters. A delayed Shanghai reprint compared to live Western quote can create illusionary spreads. Running out can mean low registered inventory, high paper claims, or supply trouble at the screen price. Markets can pull supply from multiple places. Metal moves between categories, participants roll positions. Exchanges and clearinghouses survive stress, margins change, risk controls adjust, rails widen. Even if the world is messy, opening gaps are useful for traders but not a prophecy. Entertainment versus decision-making. Enjoy the drama, but don't let it hijack your nervous system. Acknowledge manipulation exists, but not every red candle is a coordinated attack. Zoom back to China. Holiday schedule closures and resumptions snap back liquidity and news. Next 24 hours after reopen are often more important than the first 24 minutes. Spoofing doesn't mean every move is spoofing. Markets move for boring reasons too. Hedging, rebalancing, margin changes, normal price discovery can look ugly in the moment.